Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day. Good morning, traders and investors. Welcome to this Monday, March 20th edition of Benzinga's Pre-Market Prep. I'm Spencer Israel here with Joel Elconin and Dennis Dick. On today's show, got a couple guests for you. Chris Versace is joining us at 8:15. He is the CIO of Tematica Research, the co-author of the book Cocktail Investing. And then at 8:35 we're going to be joined by Tommy Lackey. He is the managing partner and portfolio manager at Relativity Capital Advisors. But before we get to them, we have to talk about the volatility at the close on Friday. I know there was a lot of stocks that had Dennis's eye, so we're going to talk about that. But before we even get to that, we're going to talk to Joel. He's going to tell us how the S&Ps are doing. And also, Joel, congratulations. Michigan is in the Sweet 16.
Sweet 16, very happy about that. Very fun weekend watching basketball. But back to the markets here on Monday morning. Week close in the S&P futures in the last 15 half hour of trading. Down 3 points this morning. Pre-market high 74.75. So that means we got to clear that close of 75 and a quarter for any upside. On the downside, we did take out the double bottom from Thursday and Friday. Pre-market low 68.75. Look out below that. Wednesday's low 23.63. Crude got a bounce a couple days after the shellacking, but now down 73 cents here. A lot of supply coming on to the oil market. You can see the daily chart here. Had some volatility last week. Can't get back over that $50 level. And gold and silver just hanging in there. Nice bump at the end of last week. Not giving back any of those gains as of yet. Dennis, how you doing on this Monday morning?
Doing pretty good. Good weekend for you, though, with Michigan.
Yeah. I sweated it out Friday and Sunday here. So third Final Four in 5 years. You certainly,
impressive.
Yeah, you can't complain about that.
Sweet 16, not Final Four.
Oh, well, okay. It will be the second Final Four.
Oh, okay.
He's already predicting. You got the Joel prediction going for him.
Okay. All right, so Dennis, we talk about the quad witches, triple witches. Yeah. Not a lot on the open. Now, do you think this was a scenario where maybe they just waited for the close to get the stock done here? What did you see?
Yeah, the open was kind of quiet. I'd say not a lot of fireworks at all. But the close, that was one of the wildest closes probably I've seen in a long time. So for quad witch, and obviously you get those 4 times a year where you get the futures and the options and the other two expiring. And I can't even remember are the stock options and stock futures, which nobody trades anyways. But what happens sometimes is you have institutions that got to jockey their positions for the close. Maybe they got some big option positions. So they got to, buy some stock or sell some stock. And sometimes what you see is, some really big imbalances at the close. Often those get paired off and they don't move the stocks. That was not the case on Friday because you had some major movement in some major issues. And check out some of these charts here. I'll just, Joe, you can just fly through and look at the last 10 to 15 minutes of trading. Check out a chart like Procter & Gamble. Had a huge sell imbalance there near the close. And you can see in the last 20 minutes of the day, the stock was trading up near 92, closed down at 91. So a huge sell-off at the end of the day. Walmart had a huge sell imbalance. The stock was around 70, 60, ended up closing down at 69.89. So just a huge sell imbalance. PNC, another one here. And I have some positions in some of these stocks too. Short some, long some here. So full disclosure here. Some of them I don't, but I was trading these things at the close as well. So I did take some overnight. PNC gap down, I think almost $1 at the close. It was trading around 125.14. Gap down to 124.35 on the closing print. You had Home Depot running up $1 at the end of the day. You had Qualcomm selling off almost $1 QCOM at the end of the day. You even had a big stock like Apple. It had a sell imbalance, looks like two, or at least some selling pressure at the close. I didn't actually trade the Apple one, but you can see in the chart it was down 75 cents at the end of the day. So big movement here from a lot of big companies there just being pushed around by the big money institutions.
And what time were those original disclosures out at? 3:45?
Well, the public feed comes out at 3:45, but there's early feeds, that you can get that are disseminated from the floor as well. And so these start coming out on the floor as early as 2 o'clock. you start to see some of these imbalance feeds coming out. And then, obviously, at 2 o'clock it can change. They're small. It's just as, more institutions put on market close orders. And that's what the closing imbalances are. You're looking at the institutional order flow, or the orders that are on the close. So, I've written some articles about it. I can tweet it out if you want. If you want more information after, ask me about it. But I've explained it multiple times in the show. But basically, if an institution, wants out on the close, sometimes they'll say, "Sell me 10,000 market on close." That's going to get them the closing print. So if they say limit on close, then they're specifying their price. And sometimes that's why these imbalances can flip around and do funny things too. As, if you have, for example, a big institutional order to sell stock at like $25 and the stock is trading at $24.99, while when the stock goes above 25, that institutional order is going to show up in the imbalance feed because it's all of a sudden marketable at that point in time. But if the stock's trading below that $25 price, while it's not marketable at that time, it's not going to get executed. So it's not part of the imbalance feed. So as the stock climbs above 25, the imbalance is going to show up that there's 10,000 to sell, and if it goes below 25, it's not going to show up. So it can actually change multiple times as it's fluctuating around where that price was, where the institutional order was. So there's a lot of movement there sometimes on the close on these things, especially on a quadruple witch. And you can see on these stocks that was really it's not fundamental reasons moving these, it's more just institutional order flow moving this type of stuff. And a lot of times you see these moves retrace. So why we bring them up here today is, you think about it, a stock like even Home Depot or Procter and Gamble, or Walmart, let's say, for instance, Walmart, fell 75 cents in the close. You can see it's already bid up here in the pre-market. It's already trading up at $70.30 here. So it's already up 40 cents from the close. So it's already trying to retrace some of that move, that 75-cent sell-off that it had, which was just order flow based, nothing to do with company fundamentals.
And when do you know that you kind of got fleeced on some of these? Like
you want to see movement in your general. So let's say 345 comes out, you see a huge sell imbalance come out, the stock isn't moving. You can be pretty confident it's probably going to pair off. That everybody's got a feel. But if you see it start trending in the direction of the imbalance, that's maybe it's not going to pair, or maybe it's going to pair off a lot lower price. I mean, eventually they all pair off. There's got to be, if there's $1 million to sell, eventually the designated market maker is going to take it low enough to find $1 million to buy as well. So and the stock's not going to gap down to zero. So, but sometimes they got to move down in price to find that price where that stock is going to actually trade. It's a market on close order; it's got to trade out. So sometimes the stock price has to move down to actually the price where it's going to trade out. So, and you can see in Walmart they had to take it down quite a bit. Actually, it was around 70.10. It gapped down another 20 cents on the closing print for the designated market maker to find the liquidity at 69.89 to clear that sell order off the board.
Yeah. So, which one out of all of them? Which one did you have the most action in?
I traded the wall. I had about 10 or 15 that I was trading. I used to run this fully automated, but I haven't because it hasn't really been working as well as it had years and years ago. You see this just from time to time. I'd say a couple times a year you see an event where it's moving a stock like Walmart over 1%. So, so I was trading the Walmart. Actually, I did really well. I shorted the stock, right around the 345 time, and actually it came down. I was sticking, it was going in my direction, so I stuck with it. I covered around 70.10, I think 70.15, so it was a pretty good trade for me. But then I bought some stock on the closing print as well at 69.89, and I was able to flip out of that after hours. So I kind of, did pretty well. I mean, I made money on the short side, and I made some money on the long side as well. So that one worked really well for me. It was one of my better closes in a long time. And there was about 10 or 12 that I had on, just going the general direction. I think I made money on all of them. So, which is rare, that you go 12 for 12, when you're trading these things. But they were all pretty real, and they all were going in the general direction of what the imbalance was dictating. So,
right.
That information that you get can sometimes make you some money, that imbalance information, which is a public feed. And you can subscribe to that information. Variety of places you can subscribe. Ask your broker, about the public imbalance feed. The New York imbalances come out at 345 publicly. The NASDAQ comes out at 350.
And also not only using it for on the close, but just how your stocks kind of react today. If you see something out of sorts on an opening print, definitely take a look. See what that price action was going into the last 15 minutes on Friday.
This is stuff they don't talk about on CNBC. It's stuff but it's stuff why they move. You'll have a technician looking at this, and they'll try to break this down from a technical perspective, why it did this. This has nothing to do with technicals, nothing to do with fundamentals, everything to do with order flow. Huge seller in the market takes the stock down.
All right, let's get some news here. What's our newsy stocks?
Well, we don't have a ton of newsy stocks here, but there is a few here on the radar. And this ESPR, let's just talk about this one because this thing got murdered on Friday. And Spencer, can you enlighten us here? Like, I don't know what the news was on this, but the stock gap from 30 almost down to 20. And it's got it all back. So it got about half of it back Friday, got all the way up to 24.79. It's tacking on another $6 here today, and it's all the way back up to where it was, filling the gap up at 29.53. Wild ride for ESPR, but right back to where it was trading on Thursday. Spencer, what is the news here that's
Well,
drove this down and drove it back up?
Well, on Friday it was a sympathy move with the Amgen data that we got. Remember, we got
Right.
that at 9, and that was poor data, and that pretty much dragged down the entire cholesterol drug sector, which ESPR is in. And then this morning, they received FDA confirmation regarding a regulatory pathway to approval for another drug of theirs. So, good news, bad news Friday drags it down in sympathy. Better news this morning.
Joel, what do you do technically when you see something like this happen? You got a stock that gaps down basically 30%. And in one day plus a little bit of a pre-market session, we get it all back. I don't even like, how do you analyze this from a technical perspective?
From a technical perspective, get me out if I was left.
I was just down 21. It's back. I got all my losses back. Get me out. That's from a behavioral finance perspective.
Yeah.
Loss aversion right there.
Yeah, I mean, especially if you got, all the people that got caught long this thing are probably scratching their head. All the people that went for the multi-standard deviation move. Because I looked at this one, I think this one was down like 25%. And then the stock that the actual news was out on, Amgen, it was down like 6-7%. Regeneron was not down as much. So, I mean, this one, you're bouncing back up. I guess if you wrote everything out, you see the pre-market high of 30.30. You see the close of 29.65 on March 16th, which was Thursday. For me, if this thing gets back over 30, closes over 30, then, hey, you can just forget about that. I mean, you got another double top at 32, 33, 37. So I don't know. I mean,
You'd be ringing the register on this bounce this morning if you were in it.
I don't care about the trial. I don't, whatever. I saw the stock trade at 20 in the pre-market, back up. And this is another one, too, Dennis. We talk about the opening prints a lot. And you got an opening print of this one of 21.29. And it continued lower. But, boy, when it came back up through 21.29, if you would have got up and got a drink of water, it would have been at 22. So another way to use the open if you want to try and be a contrarian player.
The opening prints are big and the closing prints are big, and that's why we talk about them a lot on the show, because you have a lot of people who are in at that price and out at that price, and you have a lot of short-term traders that are in at that price and or out of that at that price, and that matters because if you're a short-term trader and you all of a sudden bought a lot of stock, or if maybe it's going to be a little bit of shakeout to shake out those short-term traders. So it's all about short-term order flow. I mean, you talk long-term institutional order flow. I mean, Fidelity's not caring about how this stock is trading here in the next or how it's going to open. They care about where it's going in the next 5 to 10 years. But all your short-term high-frequency traders care about where this thing's going in the next second. And, your short-term day traders care about where it's going in the next minute. Those are the traders that can actually move the price around a lot as well. Institutions can move the price when you have big institutional order flow on the close. But for the most part, your active movement is often just little high-frequency traders, that are moving. And obviously, if there's a lot of short-term traders that are buying a stock, sometimes there can be a shakeout. And that's why when you see a big gap down and then come back up through the price, maybe you shook all those guys out, and now the stock can actually come back.
All right, just Esteban 364. Yeah, that closing print. I mean, we talk a lot about highs of the days and lows of the days, but the closing print. I mean, if you're long, a trillion.
Just explain
Apple.
Closing print, because the language there, there's some newer listeners that might not understand what you mean by print, like the closing print. So just explain that.
It is the last trade of the day.
Big block, last trade of the
Big block,
day.
yeah. New York Stock Exchange throws it up. NASDAQ, it just kind of goes wherever the last print was. But that's the last trade of the day. And then immediately after that, you'll see an active stocks, Bank of America, Apple. You'll see trades going off immediately after. But you go to your daily chart or your Yahoo Finance, and that's where institutions, traders, day traders options positions, that's everything where it's marked. So if you had a big long position in Walmart on Friday, a big institution, you see a drop like that, the closing print is what your P&L is going to be marked on. So Spencer, 8:15, we got a guest coming
We
on.
gotta go grab Chris Versace, the CIO at Tematica Research, co-author of the book Cocktail Investing, co-host of the Cocktail Investing podcast, and a professor at NJCU School of Business. So we'll be right back.
Do we got a cocktail for him on Monday morning?
Yeah. Well, no, I thought that was your job, Dennis.
Oh, shoot.
All right.
Sorry, my bad.
So you go grab that, and we'll be right back with Chris.
Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by Benzinga Pro. I'm your co-host, Joel Alcon, along with Dennis Dick and Spencer Israel. And we have Chris Versace on the line, Chief Investment Officer at Tematica Research, co-author of the book Cocktail Investing, and co-host of the Cocktail Investing podcast. I got to talk to you about that, Chris. That we've never brought that up. Tell us about your Cocktail Investing podcast. That must have been just rocking and rolling on Friday.
Yeah, it was. Thanks for bringing that up. And of course, thanks for having me, guys. Yeah, so I used to have a podcast called Power Talk, where we would talk to everybody from Steve Forbes, Donald Rumsfeld, and the like. And after we published the book Cocktail Investing, we said, we really like to help people distill all the noise down to clear investable signals. Let's get back on the podcast bandwagon. So each week we try to have 2 episodes. One where we interview a company, public or private, just to really see what they're eyeing in the world today and how that fits with our thematic way of looking at the world. And then the second episode is what we call our speakeasy, where it's Lenore Hawkins, who's Tematica's chief macro strategist and the co-author of mine with Cocktail Investing. We go, head to toe, top to bottom, everything you need to know about the week that was and the week that's coming. So it's a real great recap and outlook of what's going on. And of course, we try to have a little fun and laughs along the way.
All right, so let's move into a couple stocks that are on your radar. Nike is supposed to report this week, and this stock is holding up kind of well with kind of retailers. I think I read at Barron's over the weekend that Morgan Stanley is kind of looking for the earnings finally to bottom out here. Nice technical setup on the chart, resistance at 58 level, nice support under 57. Give us your short-term and long-term outlook here for Nike.
Yeah, so short term, we're really looking to see how Nike is fending off Adidas, to be quite honest with you, Joel. They have been coming on very, very strong at a time when that very fickle tween teen market seems to be abandoning Under Armour. And, to me, Under Armour is the one that has all the question marks on it. If you go around and you look at Dick's and others, we just see a very vibrant product offering from Nike, not just in new footwear, but really they are killing it with new designs for not only men's, but really the women's market. Remember, that's been a market that Under Armour has been really trying to tackle. And to be fair to Under Armour, they really haven't broken out of what they call, quote, basics, which is, blacks and grays. And meanwhile, Nike's got this, just ask any woman who goes through Dick's, and they will just comment on the array of colors and selection that Nike has. So I do think Nike has a lot of legs in the short term. Longer term, they're going to continue to tap into what we call the rise of the middle class outside the United States. And I think as more people around the globe recognize the growing pain of obesity and trying to get more active, Nike is a natural selection.
All right, staying along those lines, I think Finish Line, that stock has had some tough times as of late. Is it kind of, you got a little pair going on, long Nike, short Finish Line, or you like Finish Line as well?
Well, I mean, Finish Line for us is more of a data checkpoint along with Foot Locker. We want to see, hey, what models are selling, who is selling in terms of branded footwear, and what types of shoes are selling, whether it's casual, running, cross training, and basketball, because those data points are going to tell us, hey man, we want to be really doubling down on Nike, or maybe backpedaling, or maybe even if if Under Armour's losing share in the footwear market, which is a supposedly great market driver for them, maybe it's time to back off that Under Armour.
All right, I want to just talk to you just in general here, just Amazon stocks, Amazon-proof stocks. We talked about Tiffany's and Costco. I spent a boatload of money at Costco over the weekend because I can't get that delivered from Amazon. Where does Nike, fall into that? I mean, obviously their products are offered. They have some of their flagship stores. Would you kind of put them in the Amazon-proof, non-Amazon-proof category?
Yeah, I think there's a category somewhere in between there, right? You don't see a lot of these new, particularly basketball shoes, landing on Amazon, right? You are seeing is Nike really embrace its own direct-to-consumer. Over the weekend, I had a friend of mine who was looking to get some new shoes that were dropping, and they had to go through the Nike app, and it was a lottery system. And, so Nike's very good, I think, at creating a lot of buzz around their products. Does that make them ultimately Amazon-proof? I can't say that for sure, Joel, because if I can get my shoes delivered to me from Amazon or Zappos in 1 or 2 days, and I don't have to go to the mall, and I can return them all, that's a win-win to me.
Chris, let's move over here to the House of Mouse Disney here, and we got the Beauty and the Beast breaking records here over the weekend there on their launch, obviously, and this is giving Disney a nice pop here in the pre-market. Mm-hmm. This stock closed at 111.76, it's trading up at 112.50, and we're very close here. We're starting to come out and break out here. We're still ways off the all-time highs, which was last year, but what are you seeing on Disney?
Well, to me, Disney is the content is king company, and one of the biggest drivers of that business is going to be the movie slate, and that ripples through merchandising. We're starting to see it really impacting the parks. And remember, too, today's the first day of spring, and spring break is right around the corner, and Disney did a very nice job of once again boosting prices for the parks. So, we'll see some lifts there. But I think what we're seeing, Dennis, is Disney is starting to move into a seasonally strong period for them. Not only spring break, like I just mentioned, you mentioned Beauty and the Beast, but we've got Cars 2 coming, Guardians of the Galaxy, Spider-Man Homecoming. So we are going to see the box office really move into the forefront of the business model. And I think that's fantastic for Disney.
What about Netflix? They obviously have a couple new shows. House of Cards coming out as their big one that's coming out back in May here. But Netflix, the last, I'm not sure which one, Spencer, it was, but one of them didn't do that well. One of their newer shows that just came out. What was that?
Iron Fist.
I think you guys are talking about that new Marvel show, the Iron Fist.
Yeah.
I got to tell you, I started watching it, and I'm only going to say that I think in 24 hours. I made it to 5 episodes, so it's definitely in my book binge-worthy.
Oh, so it's better than maybe what the reviews were saying. But okay, well, what are you seeing? What are you seeing in the Netflix stock? Like you got valuation, obviously, is the major issue, but
yeah. So that's the major issue. The bigger concern I have is we're starting to see a lot more competition come into the original programming. I don't know if you guys noticed, but I think late last week Amazon dropped its 5 new shows that it's looking to beta to see which ones go into production. We're seeing that. We're seeing Hulu and others. So the real standout that they had that began originally with House of Cards, I think is starting to fade. So I have to be honest with you guys. I'm a little less enthralled with Netflix at current levels. I'd be a bigger buyer on a pullback, I think.
All right, let's move on to another stock here, and this is a pretty looking chart. Universal Display Corp.
Oh,
OLED looking to break out here now. Are they going in the
this,
next iPhone, or is that am I mixing that up with like
no,
LITE?
no, 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 no. I mean, look, there. Of course, we don't know for sure, Joel, but there's every indication that OLEDs, the organic light emitting diode display, will be adopted in at least one iPhone model. And remember, this is the big refresh, the 10-year anniversary. So, in a lot of respects, the 7, 7S, whatever, nice incremental designs. But Apple's really got to knock it out of the park. And I think that they're going to go this way, in part because this organic light emitting diode display consumes far less battery. Remember, battery in the smartphone is, battleground stakes. So it does look like it, but you have to remember too, we are seeing that display technology bubble through other applications. We're starting to see it in TVs. We're seeing it in wearables. We're starting to see it show up, believe it or not, in dashboards of cars that we're seeing now in beta stage over at the auto shows. So there's a whole opening of markets. I liken it to maybe about a decade or more ago with LEDs, which drove pre-stock, right? You're seeing a sea change in the display technology. I think OLED, the shares, have a lot of runway.
Are you going to be wearing those goggles for the virtual reality and stuff? Are you?
No,
Because I'm going to buy
no.
stock in
You mean
Advil.
those
I'd have
VR goggles? No,
yeah,
I
could.
can't imagine that I'll be doing that.
Yeah, during the cocktail investing, you could have those things on, and you could be seeing all kinds of things. All right, before we let you go here, I just want to touch on. You got a couple shorts, and I'm going to give you the easy one first here. General Motors. What do you? I mean, they had great numbers. They weren't rewarded here. I don't know. Chart's not looking great. What's your take on General Motors?
Yeah, so what we're starting to see is a couple things. One, consumer debt levels are almost back to 2007 levels. We're seeing subprime delinquencies on auto loans spike. Okay, so the real disposable income that we've got for consumers is a little wobbly here, and I'm just concerned about the ability to grow and meet expectations for the shipment numbers. And remember too, we're starting to see auto companies really ramp up the incentives. And the last part is we've had a number of years of really strong auto sales. And so I almost think that we're kind of due for a little bit of a slowdown here. And then you look at the valuation, it's not exactly compelling. There's a lot more downside based on where the stock has bottomed out over the last 2 years than there is upside from where it currently is.
All right, finally, SPG here, Simon Property Group. And I've been looking at shorting these REITs just on the whole retail factor here. I guess this is the one that I should have been picking on here. What do you think? Just with the department stores and everything, they're going to either be vacating or asking for much, much lower leases. Give us your take on Simon Property Group.
Yeah, so we actually put a short rating on this around 182.
Nice.
And the whole idea is what we call, and you alluded to it, Joel, which is, the death of the mall. And, we're seeing more and more stores, Macy's, JCPenney's, and the like go out. We're also seeing smaller storefronts get remade, even by me at the Tysons Mall, which is one of the top 5 in the country. Williams-Sonoma has just gone out. North Face has gone out. So there's a lot of retail pain. And I think it gets back to that question you asked earlier about Nike. And, when we look at the mall, is it Amazon proof? And the way the mall is today, where people are, supposedly go to shop, I don't think it is. Will we see a transformation at the mall to a hub of entertainment, movies, higher end restaurants? I think we will, but that takes time and renegotiation. And I think that is what's going to hit SPG Group in the short term.
Chris Versace, Chief Investment Officer at Tematica Research. A great follow on Twitter at _Chris Versace. Great having you on. We'll talk to you again soon.
You got it. Thanks, guys.
Thanks, Chris.
All right, 8:29 here. Very, very quiet pre-market here session.
Oh, yeah.
What is going on, Dennis?
Nothing's going on. We're just sitting here. The only thing I will say, European financials are getting the beats. So you're seeing the U.S. financials get hit a little bit here in the pre-market. Deutsche Bank's trading down 3% here, 18.45. And just quietly here, the stock chart's starting to look a little bit ugly again. We've got other stocks like UBS. All your U.S. or your European financials are getting hit, and the U.S. financials are down in sympathy. We got Bank of America trading down about 0.5%. Citigroup's down 25 cents. Just looking here, we've got actually imbalances just came out. Bank of America's got 270,000 to sell. J.P. Morgan's trading down the pre-market, so a little bit weak in the financials, and that's to be expected when you obviously see the European financials down as much as they are.
Yeah, let's just talk about this Bank America here. Had the move by the Fed last week, and this thing has gone down since then. You had the move on Wednesday by the Fed. You hung in there. Actually, ended up the day down 16 cents. Quiet day on Thursday, but lost that $25 level on Friday. A lot of error between 24 and 25 here, Dennis. Is this finally a consolidation to be resolved to the downside here in Bank America?
I mean, you have a breakdown in the chart here. I would say support was around that $25 area, so it's slightly through it. I want to see what it does today. We're trading down in the pre-market here. As long as it stays below $25, I think the bets are to the short side. But if we can get back up over 25, it's still hard to fight the overall trend because the trend is your friend here, and there's still a hard uptrend in this thing when you look at it from the last 3 months, even though it's been weak over the course of the last few days. I mean, we maybe didn't get exactly what we wanted from the Fed. They wanted to hear maybe a little bit more hawkish tone. They did hit the financials right after, the Fed decision there, even though interest rates went up. We were saying, a lot of that is priced in. It was what they were going to say going forward, and they maybe weren't as hawkish as the financials wanted to hear. So, you look at a stock chart like Bank of America, you can look at JP Morgan, they kind of look the same. Morgan Stanley actually broke down a little bit more. It's a little bit more pronounced when you look at the chart on that one. That was a really ugly candle for it on Friday, where the stock fell over $1. A lot of that, maybe just a one-off, but, they're getting hit here a little bit in the pre-market as well. So, it's right now the shorts are getting a little more of a case here on the financials.
Can we talk order flow here for a little bit because
sure.
I was pestering you a little bit here on Friday about Ford. And you were just saying, you were talking about the book, and you were just saying, man, there's just so much stock in there above, and you rattled off those levels for public information, right? 100,000, 200,000, 800,000. Then I said, well, what about on the downside? And you're like, no, we've traded down to 1240, 1246, 1245. So there was nothing there. Man, this thing tried to rally. Couldn't, and ended up coming right back down to the bottom of the trading range. What I'm asking you now about Bank of America is, obviously, you had someone that really wanted to sell a chunk near 26, right?
For
you got up to 25.80, 25.80. And they said, okay, we're not going to get out at 26. The high freaks are on us. We need to get the pot fed. So now we're going to move it down to 25.5, right? You have two highs at 25.55 and 25.49. Now, you think with that being down here now, you think that step-down sellers here are now going to move those institutional, levels to 25? Or you think they'll just still be trying to hang out selling at a pop-up at the 25.5 area?
Well, the reason when you get a breakdown why it's significant, even thinking, the logic behind it, like technicians, don't go into the logic of it, but the logic really is when you break down, you have a lot of people who were buying at the previous support. You have a lot of people who were short-term traders or swing traders that were thinking that's going to hold. When that comes down and breaks through it, then they're, either going to, sell right away or, maybe they're going to hold and hope it comes back. And when they're in their hope trade, we always say they're in trouble. So, the logic behind it is as it comes back into that area, those traders who bought will now sell because they don't want to take the loss aversion. It's to behavioral finance. So it comes back up in that 25 area. That's why old support becomes new resistance, because the people who are buying at support will now sell it to try to scratch out their trades. So I would say here on Bank of America is we probably got an overhead supply issue between 25 and 26, and maybe there was some institutions that were selling 26 that might get a little more happy to bring those orders down, like you were saying, Joel. But in any regard here, when you've got a consolidation period for 2.5 weeks between 24 and $25, there's probably some people who, bought in that area that maybe don't want to own it in the 24s. And that's why sometimes a breakdown can give you a little bit of a flush if those traders shake out. But you get back up into that area again, it becomes overhead resistance because you have so much overhead supply where people had bought that stock, didn't want to take the loss, gets back in the area, and now they can scratch the trade. So those buyers now become sellers.
And for all those sitting on some huge profits in Bank of America here just since the election, I mean, they'll sell into weakness. So far, it's been selling into strength, but now a little weakness here. See if Bank of America came back over $25. All right, Spencer, 8:35 guest here on Monday.
That's the same guy every week. Tommy Lackey, managing partner and portfolio manager at Relativity Capital Advisors, and we'll be right back with Tommy.
Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by Benzinga Pro. We're on the line here with Tommy Lackey. He's the managing partner and portfolio manager at Relativity Capital Advisors. Tommy, how you doing on this Monday morning?
Doing great. How about you guys?
We're doing well. At the top of the show, we covered some of the trading action from the close on Friday. Options expiration, triple witch, quad witch, whatever you want to call it. Some unusual trading activity from the close has implications for Monday, but you're putting it in a little bit of longer perspective. What do you think of that expiration and implications for this week and beyond?
Well, I think that the week held up pretty well, both on a situation of the price action. We did have a couple of runs intraday here and there that got people on their toes, but they all kind of pulled back towards the middle, and the week ended up turning out okay there. And then the breadth was pretty solid throughout the entire week, actually improving the McClellan oscillator. Also, the summation trying to turn a little bit now, and the new highs were up pretty well this week, new high versus new low indicator versus what we've seen over the last couple. So it looks like we did see some strength back in. Now, the end of the day stuff, I hate to say it, but I just take that normal for a quad witching, because anything like that towards the end of the day can get pretty hefty.
All right, just a long-term look here at the spiders and triple Qs. Starting to look a little extended, but, you see strength in the IWM and some of the other indicators. Why don't you break down those three for us?
Well, that's the thing. A lot of people right now are watching, and don't get me wrong, watching Apple and Johnson & Johnson and some of these really big mega companies in both tech and other places run the way they have, has put the Qs and also the SPY and even the Dow to some extent on a pretty straight move. The Dow the last couple of weeks has slowed down, but on a pretty straight move higher. And so now you're kind of looking at the scenario to where is it time for them to rest, and do we have a bigger pullback, which certainly could happen. However, the fact that the IWM put in such a strong week last week, I think, again, has the opportunity to extend this thing just a little bit if it can keep that traction.
All right, let's move on to the nitrous scanner here. You got a few stocks in there. Let's start with a biotech. Don't see many of these breaking out. RGEN, big day on Friday. What do you think of Repligen?
Well, you didn't see many of them breaking out on Friday, but biotech has certainly been shoring up for the last 2 to 3 weeks pretty well. And so to see one like this, it's a smaller player, start to move out of a consolidation like this is a good one, good scenario, I think. Now, the one thing you have to look at is a little bit maybe intermediate term on this one, not a short-term play, because you do have some resistance right above at 36 and some more at 38. But if it can get kind of and fight through those two, I think this one can move.
All right, moving into a small software company, moving out of a base, BCOF. What do you see for this one?
That BCOV was an interesting one because it came off so hard from its highs in late 2016 down to a pretty strong support area from late 2015 around the 7 range, and bounced off of it at the beginning of February. And since then, it's been moving up, then moved sideways for about 3 or 4 weeks, and then it broke out again on Friday on volume. And again, when you have a not so strong day and you start to see some of these guys breaking out like this that are not big options plays, they're just a stock that's out there, then I think it's worth taking note.
All right, J&J Snack Foods here, JJSF. You talked about this a few weeks ago. What are they, the pretzel makers? Do you know what their products are, JJSF, or you just like to trade the stock because it's going straight up?
I don't have any clue, but I think what we talked about last week was the fact that the consolidation was so tight right there at the highs after the week and a half of the run up, which was such a high volume print. And I think that's one thing a lot of people don't really watch is like in the first few of those sideways days in late February, the volume prints were really high as it held it up there. And that's one of the things we talked about watching for the breakout. And this one obviously did go, but I just thought it was watching for that kind of accumulation.
All right, CCEP, E, is that Coca-Cola Enterprises here, moving over consolidation? This is a little bit slower.
It is.
Go ahead.
Yeah, I mean, it had a big run off the beginning of the year, moved sideways for a little over a month, and now it's starting to move out of that consolidation. The only thing you have right now, and I think what caught it Friday, was a 200-day moving average is right in this spot. But the structure of the chart looks like it could continue to move out.
Yeah, it seems like we're moving over 36 here, a little bit of a slow mover. Another stock, this might be the first time it's ever mentioned on the show. What are you seeing in LGIH?
Yeah, this is one of the lesser-known builders, and I thought it was very interesting how it gapped up on its earnings and then has faded. But something I like to watch for is when you have a situation like this to where they bring it down into a gap, but then they can't close the whole gap. To me, that just shows that they lost control. The buyers lost control long enough after the gap up that they did push it down in there. But you had some more people decide to show up and not let it get all the way down to close that gap, because it's a pretty bad sign if a gap like that big closes that quickly. And so the fact that it's back over it, I think now you just wait and let it clear. On this one, I had let it clear 33.70, and this one probably continues to move on up. And builders have been a pretty strong area recently too, so it could play some catch up.
And finally here, Radware, trading here at the $16 level. Nice bump up, had the pullback, bunching up at $16. What are you seeing in RDWR?
I think this is definitely a look both ways play, which means if it falls under this recent low, it's probably a short. If it goes over, it doesn't even have to go over all the way over the high on this one. If you notice, I have in there at 16.10, which was the high close on this little move. This is one of those moves that we've talked about before too, that's kind of an internal breakout that could likely push it over that higher breakout closer to 16.50. And a lot of times if you see these little internal consolidations break higher, it can give them enough force or enough thrust to get through the second one as well.
Tommy, let's jump into the meltdown scan. And this is one that Citron's had right here for a long time. MNK, the stock, I think Citron came out bearish note on it back in November, I think. You can see when the stock went from about $66 down to 60 and then followed through to 55. It's now down here at $46. I'm not sure if Andrew Left has covered his position here or not, but it was a good call by Citron here. But what is Tommy Lackey seeing in the charts on MNK at 46.90?
I'm waiting to see how it reacts around 45. And basically with this one, because it looks like it tried to bounce back up recently and get back over the previous support that became resistance. It got rejected there, and it got rejected at the falling 20 SMA on the weekly chart. So now the 45 level is a pretty important level. I don't have to get all the way down to 44 where that tail is, but that 45 level I think is the level that if it doesn't defend it this time, which I think it might not, then this one definitely can be a quick drop.
Continuing with the meltdown scanner, GVA, Granite Construction. That stock had a tough couple of days here, 53 down into the 48 handle now. What do you see in GVA?
Well, and this is one that I think you have to be a little careful with because it has been down so much Friday and then a little bit Thursday. However, you can see that it was a big volume bounce there last week. Not last week, a few weeks back, that it came off those lows and then really kind of came back up. Let me see if I can get that date for us. On 2/17. It fell down there, bounced really big with a big hammer, turned green, just a nice looking hammer there. And the fact that it's already back down there and failing at that level, I think gives it some room on down. And this one I think could easily test 44, which is about 10% from here.
Here's a nice setup. Looking at this $20 level in CVI, that's Charlie Victor Ida. CVR Energy just hanging here, $20. Man, takes that out. Look out below.
Yeah, and you have a lot of energy that's looking that way. Now, the only thing you look at here is this is sitting right on the 150 SMA, which has basically found support there in the past. But again, the energy complex is in such a tough spot. If oil doesn't find some action here soon to the positive side, I think a lot of energy names are going to continue to suffer.
Stock that was moving up and then it had its earnings report and it's been coming down is Ciena, CIEN. See the gap down the chart from 26 down through 25 and down to 24 and lower. Now it's at 23.78 here, CIEN.
Yeah, came right down to the 150 SMA, bounced off of it pretty strong the following day, but now it's right back up under the 8 EMA, which is a very popular trader's moving average. And so that's where you could find some resistance here, where I put in my notes that this is either a weak back test of that level that it broke down around 24. And so if you see it fail from here on some okay volume, then it might be a short for you against, say, 24.50 or maybe even 24.70. Or if it breaks above this with some strength, then you're looking at a failed breakdown. This one could move back in to close that gap or more pretty quickly, because Sienna has been a pretty hot name.
Last one from the Meltdown scanner, ABG Asbury Automotive Group.
Yeah, a lot of the automotive groups look bad. KMX was on a different list of mine. But ABG here, off of this one, just looked to me like a very weak bear flag that started to break on Friday. Now, again, this one's sitting right at the 100 SMA, which is where that original bounce was early last week. So it breaks down below, I'd say, 61.30, then this one continues lower.
Looking at some options flow here now. We got a couple stocks here of interest on there. One we haven't talked about on the show in a long time, eBay. What are you seeing from the options in eBay?
eBay just has a really strong green flow right now. I can pull up a little bit and give you a couple of ideas. But again, it's not just the OI or open interest. One of the things Joe that I work with keeps up with so much is the actual notable trades. He follows all the bigger trades, says they're more important than just the open interest in general. And eBay has been continuing to get pretty pounded for the last, probably since late December. But since early March, it's really had some strong put sales below, which a lot of times when they're willing to sell puts and own the shares down there is a good sign. And then on Wednesday, had a pretty large, about 6,000 May 35 calls were bought, a little less than about 5,600. And, when you start to get bigger plays like that where they get some solid premium in them and the chart has already suffered a little bit, it kind of puts you in the position to kind of look and see if it's not going to have a little bit of a bounce back on a scenario like that.
Dr. J out of the chat wants your thoughts on CF Industries. Woohoo, we come down from 37 to under 29. Former support area here, Tommy. What do you think? Think finally on the rebound here, or a lot of overhead supply?
Well, I think we talked about this one a few weeks ago as well before it came down, or right as it was about it just started that turn. And it looked like at that time, I think the option flow was getting a little bit bearish on it and putting in that situation. The only thing I would say is that it has pulled back pretty significantly. It's right at its 150 and 200 SMA and a pretty big volume at price or VAP area in this 29 area. And then we also on Thursday or Wednesday saw about 1,000 August 27.5 puts sold that could very likely limit the downside on this one as well. So I think you want to watch and be very careful. You could probably play it down to around that 27.50 or slightly lower and see if this doesn't get somewhat of a rebound. It looks like in pre-market it's gapping up a little bit.
What's going on in the options activity in General Motors here, dear Tarhart here in the Motor City?
General Motors is starting to get a little bit more mixed, but it had been very bullish flow up until just I'd say in the last month. And it's starting to get a little more mixed, but it still leans very green. In fact, on Friday, there was a pretty large buy in April 37 calls. April 7th weekly 37 calls. There's about 3,000 of those bought. And then on Friday, there was about couple thousand in the April 35 calls bought as well. And those are initial trades. Those aren't a bunch of retail people piecing it together. That's someone going in and buying a chunk.
Yeah, buying into weakness here as GM has come off that $38 level. Tommy Lackey, managing partner and portfolio manager at Relativity Capital Advisors, joining us here on Benzinga's Pre-Market Prep. Tommy, thanks a lot. We'll talk to you next Monday.
Thanks, guys. Hope everybody has a great week. Good luck out there.
All right,
Thanks, Tommy.
Covered a lot of stocks there. Dennis, I saw you were getting in a little discussion here with Esteban 364. Did you want to pick up on that?
Yeah, maybe I'll just talk, just about order flow trading. If people, a couple of people in the chat asking me, where do you find good information on order flow trading? It's a difficult thing to find out there. I mean, you find a lot of books on technical analysis. You don't find a lot. It's something I've actually considered writing, and I probably maybe eventually would do it. It's just time for me to write a book is a long time. I've written a lot of little articles and stuff like this, some in CFA magazine. I've also done some presentations, and I do some presentations on this type of stuff. But it's hard to find good books on like order flow trading. When I say order flow trading, I'm talking about a number of things. First, I'm talking about obviously, just looking, at the quotes, and looking at level 2 quotes, and it's taking a look at the book and taking a look at, the depth of book quotations and trying to get a feel for where a stock thickens up, where it might struggle to get through. And when I say thickens up, it means there's a lot of, for example, just from last week, the Ford trade that we were talking about, I was citing, in the book that there's sell orders at 1273, big ones at 1274, 1275, 1276. I'm like, it's very thick. So that means it's going to have a difficult time going through there without a catalyst to take out all those sell orders. And we can see, and actually I had a good trade on it Friday. I shorted it right at 1272, which was the opening print, because I knew there was a lot of size above. So unless, there's some big follow through, there's some type of catalyst, it's probably going to struggle to get through there. And that trade worked out because it pulled back. So I was using the order flow, looking at the orders in the book, to gauge how thick the stock was, to see where the path of least resistance was. This is all public information. You can just get and subscribe to those order book feeds, and you can kind of get a feel for where, the stock thickens up in certain cases. Now, that being said, middle of the day is tricky because there's so many high frequency trading orders on an intraday basis that it's very difficult to gauge, where it thickens up because everything just looks thick. But 99% of those high frequency trading orders are envelope orders. Those are just orders that are just surrounding, the current fair value of the stock. And basically, they're using the S&P futures. So S&P futures move down, their orders will move down as well. So it's difficult to just jump in and say, okay, well, it looks thick here, because on an intraday basis, a lot of those orders aren't really solid. They're real orders at the time, but they're only real for, microseconds sometimes. So they're moving around so much. That's why I like to look at the order books in the morning before the market opens. And that gives me a better feel for, where the real, true, bigger institutional orders might be. So that's one, way of using order flow trading, but there's other things too. We talk about imbalances. I talk about these every single day on the show. At 8:30 in the morning, you start getting the NYSE imbalances. Unfortunately, NASDAQ doesn't give them till 9:28, so you don't get a lot of time to react on the NASDAQ ones. But for instance, you're looking this morning, Bank of America has 363,000 shares to sell at the open. So what that means is, there's right now at the close, because these opening imbalances are based on the closing price. So 24.86 is the closing price. So if you put a sell order for 1,000 shares at 24.85, that will contribute to the sell imbalance of 1,000 shares because it's below the closing price. So right now it's telling you, when you see basically, just in a nutshell, you see 363,000 to sell at the open, the stock is probably going to open lower if it was to open at this time. Now, an institution might just come in and say buy 500,000. Then the sell imbalance will flip to 140,000 shares to buy because there's 363 to sell, 500,000 comes above 24.86, and it will flip to buy. So you can see this isn't static information. It's information that's constantly moving as new orders come into the book. So what happens is a lot of times you'll look and they'll see 363,000 to sell, but a lot of institutions don't put their hand out there. They don't want people to game their order flow, so they don't show their hand until the last few seconds. So you might have a floor broker on the floor. All of a sudden, that's got a holding an order, and he's going to put that order out there at the last second, and that can change everything. So those numbers really change in the last few seconds right before the market opens. So, but it's an indication, of early order flow of whether somebody wants to sell or somebody wants to buy, or maybe there's multiple institutions that want to sell or buy. So that's another tool that you can use. But there's definitely a lot to order flow trading. So there's a lot of information that really isn't out there, but we talk about it a lot on the show. So I like that we can jump into this every once in a while, and it's something that I've used in my trading for 18 years.
Are some of the orders in the book fake? Will the walls move as the price moves? That's from B. Morris. And you did comment on that a little bit. A lot of the good orders, like the GTC orders, they're in there, right? Do they still have
You start seeing those at 7:30 in the morning. New York book opens at 7:30 in the morning. So 2 hours before the market opens. So that's the kind of stuff that's solid usually, the stuff that's out there. If I see an order out there that's been out there for a couple of days, you're pretty sure it's a GTC order. It's probably out there until it gets executed. So it gives you a pretty good feel for, where, there's, maybe a big order that's going to block the stock from going higher. If there's 100,000 shares to sell of a $50 stock going higher, the math on that just tells you, well, if it's $50, it's going to be $5 million, orders to take that out. So it's a lot of money to take that out. And that's why a lot of times stocks stop at whole numbers, because it's a big institutional size, maybe sitting at those whole numbers that is kind of blocking it from going ahead. But, yes, some of the orders are fake in the book, but, it's illegal to put fake orders in the book. Like that's called layering when you start putting fake orders out there in the book. So you don't typically see a lot of fake orders. What you see is orders that are constantly adjusting. A lot of these fake people that would say fake orders, but a lot of the fake orders that are being, people are saying are fake orders are actually high frequency trading orders that are simply, again, enveloping around fair value. So they're moving constantly. They're constantly, digesting new information and moving around to where their new fair value of the stock is. And because they're constantly changing all the time, people say they're fake because they're not solid. Well, they're still real orders. They're real orders for that microsecond or for that second, but then they move. But it's not like an institutional order that Fidelity wants to buy the stock and they don't care. They put on their 100,000. They don't care what happens in the next 5 minutes. High frequency traders are putting out, orders for 1,000 shares, 1,000 shares here, 1,000 shares there. They've got to constantly move because their profit margins are so low. If the S&P futures all of a sudden fall 3 points, they're going to get filled on all their longs and they're going to have a lot of losing trades on the hands. So they have to constantly adjust those orders for S&P futures movement. So, and that's just one factor. There could be other things in the sector. Just for example, we were talking the European banks. I mean, if you're a market maker, a high frequency market maker in the U.S. banks right now, as the European banks move around, that's one factor that's going to go into pricing the U.S. Banks here, and it's a big factor this morning. I mean, that's why you're seeing the U.S. banks trade down significantly here this morning, is because the European banks are getting the beats. So, and then there's imbalances. There's a lot of factors that go into that pricing. But I wouldn't say they're necessarily fake orders. They're just orders that aren't solid. They're orders that move around, sometimes, more than even 1 or 2 times a second. Sometimes they can move around multiple times in the same second.
All right, we've got just a minute or two left here. Just wanted a few notes here from a little bit of reading over the weekend. Barron's coming out bullish here again on Apple. Basically, they are looking for more upside from the services. Apple traded in the green here by 34 cents. Besides the market be down by 4.25, they talked about it easily going to 150. Looking at the daily charts here, we did clear that 140 hurdle. Double top to contend with. Last 2 highs, last 2 sessions. 141, that's the bogey on the upside here. And then I'll talk about one they talked about on the negative side here, Grubhub. Continued downside for that. Now this one is in danger here of breaking a multiples area of support, GRUB. Just too much competition according to Barron's, and I kind of have to agree with them on that one. Let's just look. Trading down a little bit in the pre-market. The low of the move has been 33.13, so keep an eye on that if you're looking for potential support. Dennis, any final thoughts here?
Well, we didn't get a chance to get to the ratings, so I'll just give you a couple of highlights here. 2 that are on my radar for today. Shake Shack catches an upgrade from Wedbush here. It is trading up about 55 cents here in the pre-market. And then you have FireEye, F-E-Y-E, caught an upgrade from Bank America this morning. They're jacking their price target up to $18. They're putting a buy rating on the thing, and that's why FEYE trading up 6% in the pre-market as well.
I want to highlight too. Snapchat finally got a buy rating from sell side.
Really?
Yep. Monis Crispy Heart.
Oh, really? Not Monis Crispy Heart.
Okay. Buy rating and a $25 price target on Snap.
Well, okay, stock's getting a 30-cent lift here in the pre-market. Joel, give us, your technical thoughts here. I know it's not a lot of information. Fari Hamzy, who we have on the show sometimes, doesn't even like to talk about a stock until it has 90 days of technical information here. But, I know you can do something with this, Joel.
Oh,
give us
of course I can. Well, if you want to get real bullish here, you could say you've had about a 10-point move, so 5.25 would take you back up to 24 and change. But I'm just going to look at this 2069 in the meantime. That was your high from Thursday, so keep an eye on that. Above that, 2140. 1954, if it gets a pullback to that area, that could be minor support. I've never heard of this firm, so I'm not, running out. And
Oh yeah, they're
Yeah,
one
they
of the
have?
smaller ones, but
Okay.
yeah, they can move it. They can move price.
I mean, best case scenario would be a 50% retracement up to 24.50, but I don't see that happening today or really anytime soon. All right, Spencer, you want to wrap up the show and preview Tuesday's show?
Looking ahead to tomorrow, we have Gary Kartbaum, investment advisor and author, and then the proprietor of GaryK.com. Also, we're going to be joined by Nick Shaheen, as we are every Tuesday. Hope you enjoyed today's show. Please remember that all the information, material, and content is for informational purposes only and not meant to be investing advice. Have a good rest of your Monday, and we'll hope you'll be back with us tomorrow.
Whether you're a short-term swing trader or a long-term investor, you need to check out Thinkorswim, brought to you by TD Ameritrade. There's a reason why Thinkorswim has been named the #1 trading platform, because it has it all. With Thinkorswim, you can trade stocks, options, futures, forex, and virtually every other type of order. Get notifications on mobile devices and interact with other traders in chat rooms. You can also use technical indicators and see the latest investing and trading education in Think Money magazine. If you want to keep up with the markets, you need Thinkorswim. To experience everything Thinkorswim has to offer, open a TD Ameritrade account today. Thinkorswim, the online trading platform for traders and investors. TD Ameritrade, member SIPC. All investing involves risks.